Welcome to Breaking News to Trading Moves, where we take market headlines and translate them into clear themes and watch lists for you. Today, we're focusing on a canceled acquisition, one involving Verisk Analytics. That's ticker VRSK. They were attempting to purchase a company called AccuLynx. And this event, it gives us a really sharp lesson, not just about a specific corporate strategy, but about the increasing complexity of regulatory timelines in the whole M&A space.
Precisely. For you, this gives a really clear view of how a deal can just collapse, even without a formal veto from regulators. And we can see the immediate impact that has on capital allocation, on competitive dynamics, especially in the software space. So our focus is squarely on the facts, what happened, why the timeline was the thing that mattered, and, who ends up winning and who loses from this sudden termination.
Okay, so let's establish the core facts first. Let's just set the scene. Verisk Analytics, VRSK, has terminated its planned acquisition of AccuLynx.
Right, and AccuLynx, for context, provides software specifically for roofing contractors.
So a very specialized piece of software. And this was a deal that Verisk seemed to have a lot of strategic ambition pinned on, and seeing it unravel, so it suddenly gives us a lot to talk about.
It does. And to really frame the scale here,
Yeah.
you have to look at the numbers. The deal was structured as an approximately $2.35 billion all-cash acquisition.
$2.35 billion. That's a major move for Verisk.
A very big move. It represented a huge chunk of their available capital and, their financing capacity. And their rationale was crystal clear. They wanted this specific software to expand their ecosystem. See, Verisk is already a dominant force on the claims side of the insurance world, mostly through their product suite called Xactware, which insurers use to estimate the cost of claims.
Okay, so they're strong with the insurers. And AccuLynx.
AccuLynx is on the other side of that equation.
Yeah.
They're known for their contractor management tools. We're talking everything from creating an estimate, digital proposals, scheduling, project oversight, even the financial tracking for the contractor.
I see. So Verisk wanted to bridge that gap.
Exactly. AccuLynx was the critical bridge in that whole claims to repair lifecycle. They wanted to create one seamless, integrated workflow. You take a claims estimate from Xactware on the insurer side, and you immediately port that data right into the contractor's operational software, which would have been AccuLynx. The idea was to streamline everything, reduce disputes, and just speed up the whole settlement process.
That strategy sounds solid, which makes the failure here even more of a headache for Verisk and its investors. So let's talk about why it failed. You said it wasn't a formal rejection by the U.S. Federal Trade Commission, the FTC.
That's the crucial point. It was a failure of time. That procedural delay is the whole story here, and it's a lesson for any company planning a large acquisition.
So what does that mean, a failure of time?
Well, when companies agree to a large deal, the purchase agreement always includes a contractually defined deadline. It's sometimes called a drop-dead date or an outside date. And by this date, all the conditions for closing, and this is critical, regulatory approval being a big one, they all have to be met. The specific date here, which had already been extended, was December 26, 2025.
So the clock was ticking.
The clock was ticking. And the deal failed because the FTC's review process just wasn't done by that deadline. It wasn't a no. The agency hadn't blocked the deal or demanded they sell off parts of the business. They were just still reviewing it.
And when the clock ran out?
When the clock ran out, Verisk exercised its contractual right to terminate the agreement because that condition of getting approval wasn't satisfied. And this really highlights a growing trend. The regulatory timing itself is now a primary risk for big M&A deals.
So Verisk says they had the right to walk away. But the fallout from this, it sounds like it's not a clean break. AccuLynx is disputing the termination.
Far from it. This is not a friendly handshake and a parting of ways. The disagreement really comes down to the specifics in the contract language. AccuLynx is challenging the validity of Verisk's termination.
So they're basically saying Verisk didn't have the right to pull the plug.
That seems to be the argument. They might be claiming Verisk failed to meet its own obligations to push the deal through, or that the deadline was breached improperly. We don't have the exact filing details yet, but that's the nature of the dispute.
And what's Verisk's response?
Verisk has stated it intends to, quote, vigorously defend its position. That language suggests a legal battle is probably on the way.
Right, not just over the contract itself, but probably over things like termination fees.
Exactly. Breach of contract claims, termination fees. This stuff can be substantial in a deal this size. So that legal uncertainty immediately complicates the whole clean break narrative that Verisk wants to project. The market now has to factor in potential litigation costs.
Okay, so there's the legal mess. What about the financial cleanup? Verisk had already prepared for this $2.35 billion expense.
Yes, and they are moving very quickly on that front, which is what you'd expect. It's essential for investor confidence. To finance a big chunk of this, Verisk had issued $1.5 billion in new debt.
Debt that was specifically raised for this acquisition.
Specifically for this. So now that the deal is off, Verisk plans to redeem that $1.5 billion. This is a critical step. It immediately takes that acquisition-related leverage off their balance sheet.
And by moving quickly, what message does that send?
It signals to the market that management is prioritizing financial discipline above all else. They avoid carrying unnecessary debt that would just drag down their financial metrics, increase their interest expense. It would hurt their agility. This rapid deleveraging is a very deliberate signal.
Okay, this headline clearly has implications far beyond just Verisk and AccuLynx. It speaks to how M&A is working right now. Let's dig into the three biggest implications, starting with the one that killed the deal itself: regulatory timing.
Right. If you distill the lesson here, it's that regulatory timing has been elevated to the ultimate risk factor. We've moved past the simple question of, will the FTC approve this?
And now the question is,
how long will the FTC take to approve this? This situation shows that just the procedural delay, not even a final legal decision, is enough to run out the clock and kill a major transaction.
why is this happening now more than ever? Has something changed?
The context is that the current antitrust enforcement philosophy, especially at the FTC, has shifted. They're taking a much more rigorous, much more time-consuming approach to reviewing mergers.
So what used to be a 6 or 9 month process
Is now routinely stretching to 18 months or even longer for large, complex deals. Regulators often use something called a second request, which is this massive, incredibly detailed information request sent to the companies. And that process alone effectively forces a dramatic extension of the timeline.
So the FTC doesn't even have to formally block the deal. They can just be slow enough that the contract expires.
That's it exactly. And these delays are incredibly costly. There are high carrying costs for M&A deals. You have ongoing advisory fees.
Yeah.
You have legal defense costs fighting the regulators. And you have the massive opportunity costs for the management team who are pulled away from the core business.
It becomes unsustainable.
It does. And think about the financial models. Every major acquisition is based on a specific internal rate of return, an IRR, which assumes a target closing date. If you modeled that at 12 months, and suddenly the FTC review drags it out to 24 months, the IRR for the entire deal just collapses.
So the deal itself becomes a bad deal financially, even if it were to eventually be approved.
Precisely. The timing risk is fatal because it erodes the financial justification for the transaction in the first place.
That means companies planning future deals have to completely change how they approach this. What does that look like in practice? How do you write contracts now?
It means contracts have to be drafted with a complete overhaul of how you allocate regulatory risk. That old 6 to 9 month review window is, for any deal that's going to get real FTC scrutiny, it's obsolete.
So you have to model in a much longer timeline from the start.
You have to model in 18 to 24 months as a baseline. This means writing much longer drop-dead dates to the contract, or including these massive hell or high water commitments where the buyer agrees to fight the FTC for as long as it takes.
Or I guess you could have much larger breakup fees.
That's the other side of it. Price in much larger reverse termination fees. That's the penalty the buyer pays the seller if the deal fails on regulatory grounds, to compensate the seller for all that wasted time and uncertainty. The strategic lesson is clear. Completion risk is now overwhelmingly about the probability of hitting a contractual deadline.
Okay, let's move to the second implication, capital allocation. Verisk suddenly has $2.35 billion that is now unallocated. That requires a complete and immediate change in their financial strategy.
It requires an immediate pivot, absolutely. And management's credibility with investors really depends on how they reallocate that capital. As we mentioned, the first priority is unwinding the financing for the deal, that $1.5 billion in debt.
And you mentioned that's not a cost-free process.
Not at all. In the bond market, debt that's issued for a specific M&A purpose often has clauses about callability and prepayment. Verisk has to redeem this debt now, and they will likely face prepayment penalties, or what are called make-whole provisions.
Which is basically a fee to retire the debt early.
Yes, it compensates the bondholders for the future interest payments they were expecting to receive. But paying that penalty now is the rational financial move. It frees the company from paying years of interest on debt they no longer need.
How does the market see that? Does pick a penalty to get rid of debt look bad?
No, quite the opposite. The market sees that as a sign of financial discipline and agility. By moving fast to retire that $1.5 billion, Verisk immediately lowers its leverage ratio and improves its near-term EBITDA because they get rid of that interest expense. It restores their capital strength.
So once that cleanup is done, what about the rest of the capital? Their big growth plan just failed. What does the market expect them to do now?
The focus immediately shifts to shareholder returns. When a big external growth plan like an acquisition falls through, investors often conclude that the best available investment for the company is its own stock.
So buybacks.
Exactly. The market expects management to prioritize expanded share repurchase programs, buybacks, and maybe even boost the dividend. It supports the stock price, and it satisfies the demand for capital return from investors who might have been skeptical of the big acquisition in the first place.
But I have to ask, does that look like a failure of imagination? Is just pivoting to buybacks an admission that they don't have another plan for growth?
And that is the critical tension management has to address on their next earnings call. Buybacks make the market happy in the short term, but a failure of a major deal like this does force Verisk to reevaluate its whole growth strategy.
So what's the alternative path?
Instead of one large, complex deal that attracted all this STC scrutiny, the alternative is to pursue smaller, highly targeted bolt-on acquisitions.
Smaller deals that fly under the regulatory radar?
Right. These smaller deals often fall below the revenue or market share thresholds that trigger an extensive FTC review. This would allow Verisk to still expand its workflow capabilities, but in a more modular way, buying small, specialized software companies without taking on the same level of deadline risk.
The challenge there, I imagine, is whether a bunch of small deals can ever add up to the same growth potential as the one big transformative AccuLynx deal would have.
That's the question they have to answer.
Okay, third implication. The original strategic idea, that single, unified workflow from the insurer to the contractor, is now on hold. That means the whole claims to repair software space is left fragmented, just like it was before.
Correct. Verisk's strength is Xactware, the industry standard for creating property damage estimates. But there's this huge functional and digital gap between creating that estimate and then managing the day-to-day operations of the contractor who actually does the work.
And AccuLynx was meant to be that bridge.
It filled that gap perfectly. It would have allowed the contractor to take the claim data and immediately turn it into a project schedule, manage their materials, communicate with the homeowner. With the deal canceled, that integration is delayed, maybe indefinitely, or they have to build it themselves, which is almost always slower.
So the market remains a collection of different point solutions.
Exactly. It's highly fragmented. You've got different software for estimating, for aerial imagery, for customer communication, for financial tracking. No one company provides that unified end-to-end solution that Verisk was aiming for.
And how does that fragmentation impact the competitive environment for all the other software providers out there?
It gives them a central breathing room, a huge amount of it. If Verisk had successfully integrated AccuLynx, it would have created an overwhelming competitive force.
How so?
Think about it. A major, well-capitalized company using its dominance in claims data through Xactware to funnel business directly into a contractor platform that it owns. That would have been incredibly disruptive to every other contractor software vendor.
That threat is now gone, at least for a while.
For the near term, it's neutralized. These existing vendors don't have to face the immediate challenge of an overpowered, integrated competitor. It gives them more time to improve their own products, raise capital, or maybe seek out other strategic partners to build their own version of a unified platform. The landscape stays dynamic instead of consolidating under Verisk's umbrella overnight.
Okay, we've laid out the consequences. Now let's look ahead. What are the specific events that could generate the next round of headlines and price movements for Verisk, that's VRSK, and the sector? This is our watch list for the next few quarters.
The environment right now is really defined by uncertainty in 3 specific areas, and we need to watch for definitive actions or filings in each one. First, we have to monitor the legal uncertainty. As we said, AccuLynx is disputing the termination. So the critical next steps will be any formal court filings between Verisk and AccuLynx.
And what are we looking for in those filings? Is it just an argument over a standard breakup fee or something more?
We're looking for the scale of the claim. Standard M&A contracts have a codified termination fee, maybe a few $100 million. If the fight is just over whether that fee gets triggered, the financial outcome is somewhat predictable.
But it could be more than that.
It could be. What would create real volatility is if AccuLynx alleges a more serious breach of contract. Something like a bad faith negotiation, a claim that Verisk failed to use its reasonable best efforts to get FTC approval.
And that could expose Verisk to much larger damages.
Potentially, it could expose them to liability beyond that codified fee, maybe even damages related to the expected value of the acquisition itself. A big, complex legal claim would weigh heavily on that clean balance sheet story Verisk is trying to tell.
Okay, so that's number one. What's the second thing to watch?
Second, pay very close attention to the debt redemption details. Verisk said they intend to redeem the $1.5 billion in debt. We need to watch for the official timing and the pricing details, especially any disclosure about the size of those prepayment penalties.
And why does the timing of that matter so much to the market?
Speed is paramount here. Fast, decisive action shows that management is agile and committed to cleaning up the balance sheet. If the process is slow, or if the penalties are higher than the market expects, it could lead to disappointment. It might suggest they were unprepared for the cancellation. Investors want transparency and swift execution after a big M&A failure.
And the third catalyst.
Third, and this is maybe the most critical for their long-term valuation, is management guidance. We need to listen very closely what management says about their strategy for 2026 and beyond on their next earnings call or at investor days.
This is where they define the new narrative for the company. How will we know if they're pivoting back to buybacks or trying to find new growth?
We'll be listening for the precise allocation of that $2.35 billion capacity. If they announce a big expansion of their share repurchase authorization, the story becomes about stability, capital discipline, and returning value to shareholders. That appeals to a certain kind of investor.
The value-oriented investor.
Exactly. If, on the other hand, they quickly pivot and announce a new pipeline of smaller bolt-on acquisitions and allocate capital to that, the narrative is one of continued growth-seeking, just through a less risky approach. The language they use to describe their tolerance for M&A risk going forward will be key.
All right, let's translate all this into specific market segments. Who benefits from this deal collapsing? Let's start with Verisk itself, which, as you said, sounds a bit counterintuitive.
Right. This category benefits from the removal of risk and the new clarity on capital. Investors had been applying a discount to Verisk's stock price because of all the uncertainty. The risk of closing the deal, the risk of integrating AccuLynx, the risk of absorbing all that debt.
And now that risk is just gone.
It's off the table.
Sure.
So the market reprices the company for lower complexity, less legal uncertainty from the FTC, and most importantly, more financial flexibility. And that flexibility translates directly into the capacity for more share repurchases. Investors appreciate that discipline.
So which specific names should you monitor in this segment? Companies that are often judged on these kinds of capital decisions.
Well, you monitor Verisk itself, VRSK, as the primary beneficiary. You're looking for the stock to reflect the removal of that M&A discount. And then you look at its peers in the premium data and analytics sector.
Like who?
Think about MSCI, ticker MSCI, and S&P Global, ticker SPGI. These are seen as very resilient, high-margin data companies. When a peer like Verisk fails at a big M&A deal and pivots hard to capital returns, it reinforces the market view that these types of firms should prioritize buybacks over risky long transactions.
Okay, this next group seems more straightforward. These are the competitors who are suddenly relieved that a much larger, more integrated rival is not entering their market. It's an unexpected gift.
It's a major defensive win for them. The fear was that Verisk, using his dominance in the claims workflow with Xactware, would have been able to turn AccuLynx into an instant market leader. That vertical integration was an existential threat to independent vendors.
And now that threat is gone.
The pressure is off. The cancellation leaves the contractor software market fragmented, which allows these incumbents to maintain their footing. They can still go out and build their own partnerships with insurance carriers, something Verisk would have tried to lock down.
Who are the key names here in the specialized software segment that now have some breathing room?
We should monitor the leaders in construction management and design software. Procore Technologies, ticker PRO, is a major player in construction project coordination. They don't have to face the immediate threat of a Verisk-backed platform undercutting them in the insurance claim part of their business.
Any others?
Also companies like Autodesk, ticker ADSK, which provides essential design tools, and Trimble, ticker TRMB, which is involved in positioning of workflow solutions. The failure of Verisk to create that single integrated ecosystem means the overall competitive complexity in construction tech remains manageable for now.
And of course, there's always a sector that actually thrives on complexity and failure. The very things that killed this deal, the regulatory delay, the legal dispute, that's good for business for some firms.
It's a direct consequence of a regulatory environment with more friction. Longer FTC reviews require exponentially more work, more data collection, more economic modeling, more legal defense hours, and a termination that leads to litigation, like this one.
Means you have to bring in the dispute advisory firm.
You do. They're brought in to analyze the contracts and potential liabilities. The whole complicated deal landscape ensures that there's high demand for specialists who handle antitrust economics, compliance, and dispute resolution. They either guide a deal through the regulatory maze, or they manage the legal aftermath when it falls apart.
Which advisory names benefit from this kind of elevated complexity?
We look at firms that specialize in highly technical economic and litigation consulting. Charles River Associates, ticker CERAI, FTI Consulting, ticker FTI, and Huron Consulting Group, ticker HURN. Their business models are basically built on billing hours for complexity. When M&A deals drag on and end up in court, their revenue opportunity goes up.
Okay, now let's turn to the other side of the coin. The segment's facing losses or setbacks because this deal collapsed.
The primary operational losers here are the major property and casualty, or P&C, insurance carriers. They stood to gain the most from the efficiency this deal promised. As Verisk's major clients, they were hoping this acquisition would create a powerful streamlining of the entire claims process.
Right, because carriers are under a lot of pressure right now from rising claims costs.
Exactly. Rising costs, more catastrophic weather events. The ability to streamline that insurer-to-contractor interaction was seen as a way to claw back some efficiency. Verisk had projected that this integration could lead to real cost savings by speeding up repairs and reducing the cycle time of claims.
Delaying that vision really hurts them.
It slows down the realization of crucial efficiency gains across the entire P&C insurance world. They were hoping this would help control leakage in the claims process, which is where unexpected costs or delays inflate the final repair bill. Now, the slower existing process remains the status quo.
So which carriers would have been most disappointed by this delay? Who relies heavily on Verisk's current systems?
You'd monitor the large, publicly traded carriers with high exposure to residential property claims. Companies like Allstate, ticker ALLL, Travelers Companies, ticker TRV, and Chubb, ticker CB. They are all deeply integrated with Verisk's current estimating tools, and we're looking forward to that seamless workflow.
This one is a pretty straightforward financial hit. The investment banks and advisory firms that worked on this $2.35 billion deal are now out of a big payday.
It's an immediate and very tangible loss for them. Investment banks make the vast majority of their advisory fees when a deal successfully closes. When a headline acquisition like this gets canceled, those large completion fees just evaporate.
Do they only get paid for the initial work?
They keep the smaller retainers and fees for the preparatory work, but the big prize is gone. And it's not just that one fee. Banks often anticipate follow-on business advising on integration, debt restructuring, future equity issuance. The failure to close just shuts down a whole pipeline of potential fees.
And we know the usual suspects who advise on deals this size.
Yes, you'd monitor the major bulge bracket and boutique firms. In this case, Goldman Sachs, ticker GS, was listed as an advisor, as was the specialized firm PJT Partners, ticker PJT. The loss of fees from a multi-billion-dollar transaction definitely impacts their quarterly earnings.
And finally, this failure highlights a very specific risk for a certain kind of investor, those who bet on deal completions. For anyone studying advanced strategies, this is where that deadline risk we talked about really hurts.
This is the most acute financial loss sector. Merger arbitrage is a strategy that involves buying the stock of a company being acquired at a slight discount to the deal price. You're betting on the deal closing to capture that small price difference, the spread.
AccuLynx is private, though. So how does this impact public funds?
Right. While AccuLynx is private, this failure directly impacts publicly traded merger arbitrage funds and ETFs that manage a whole portfolio of these risks. The increase in deadline risk puts pressure on these strategies across the board. When an FTC review drags on and kills a deal, the perceived probability of completion for all similar pending deals goes down.
So the failure of this one deal causes a general repricing of regulatory risk across the entire merger arb universe.
That's it, exactly. The managers of these funds now have to reassess their risk models for every other pending deal that involves FTC scrutiny. This Veer's failure is a stark reminder that time can kill a deal, regardless of its merits. It forces them to hedge their bets, which leads to a widening of the spreads on other deals, reducing the potential profit for the whole sector.
Which publicly traded funds or indices track this kind of exposure?
For those tracking these specialized strategies, you would monitor funds like the Merger Fund, ticker MRGR, and the IQ Merger Arbitrage ETF, ticker MNA. When a high-profile deal like this collapses because of regulatory timing, it forces a systematic repricing of risk across their entire portfolio.
The termination of the Verisk AccuLynx acquisition really reminds us that regulatory timing, not just the final outcome, is a crucial factor for M&A success in today's environment. The market adjusts instantly, shifting from a complex integration story to one about capital returns and competitive fragmentation.
The key takeaway for you is to monitor the strategic pivot at Verisk, ticker VRSK. Watch how management reallocates that $2.35 billion capacity. Is it back to shareholders through buybacks or into a new, less risky bolt-on acquisition strategy? And, keep an eye on that legal battle with AccuLynx. The scale of that dispute is going to color Verisk's financial outlook for the next few quarters. That hole in their strategy is the most immediate thing for management to address.
We appreciate you trusting us to translate this headline into clear market insights. Disclaimer: this is not financial advice or buy or sell recommendations. This is purely the opinion of the author.